Time for top picks from John Hood. John has spent the past nearly hour answering your questions. Now his top picks. Top pick number one, John, a 3-year Canadian bond.
Yeah, what's happening here is that 2 years ago when COVID started, I had been using bond ETFs, and I called the bond desk at National Bank because, as you know, there is no bond exchange. Bonds are sold between institutions. And I asked them if they were seeing any problems of liquidity in the bond market. And they said, yes, it was just starting. And they were having some trouble placing a Province of Ontario bond. Within about a half an hour, I'd sold all of my bond ETFs because, again, you know, the market can dry up in bonds very quickly. And a lot of bonds, if the creditworthiness of the companies start to drop or are perceived to be dropping, those bonds can go from investment grade to junk bonds fairly quickly. So I sold them all. And I then started looking in the equity markets and trading the equity markets, but left my bond money in cash. For clients, sometimes that's a little bit difficult because you're not earning anything. But my response was, if you look at what the bond market has done so far this year, as Rob Carrick's article in the Globe said a few weeks ago, you know, practically every bond ETF was down 5 to 10%. Okay, so the question is, do you want to earn zero, or do you want to pick up a yield of 2.5% but have an actual loss of 5 to 10%? So it's a pretty obvious answer. But now it's changed because rates have started to go up quite quickly. So I wanted to get in there and start earning some money in that cash. And so I have bought Government of Canada bonds, 3 years. If bonds go up a little bit more, I'll take another tranche as well. But I'll wait. Again, it's a matter of going in gradually, and that's what I did, and that's why I like this particular bond, because I'm getting about 3.2%, 3.1% on it. So I'm happy to have that.
Okay, and top pick number two, indeed, is 3-year U.S. Treasuries. Same thinking here?
Same thinking there. It's just that, you know, I have a number of clients who have a fairly large amount of cash sitting in U.S. dollars, and we want to get that working for them rather than doing nothing or, in fact, taking a loss, as a lot of people did last year. Fortunately, we didn't on cash. So, other than, of course, inflation, et cetera, et cetera.
Okay, now we go to a sector ETF, the iShares U.S. Aerospace and Defense ETF, ticker symbol ITA. Okay,
so for those of you who are into ethical investing or green, this is the time to cover your ears because we're after the big boys in defense. The reason for that is obviously Ukraine. The U.S. has provided an awful lot of munitions to Ukraine. This is going to have to be replaced. Also, clearly, this situation with Putin is not going away. And, you know, people are hoping for regime change. I don't think that's terribly likely. This could be quite a protracted effort. And NATO, fortunately, has stepped up to the bar, and they're going to dramatically expand both their government spending commitments to NATO and dramatically increasing the number of troops, because I think that's the only way that you can deal with someone like Putin. Right now, they don't have the troops really to stop him, but they will over the next year. So I think that's going to create more defense spending, missile spending. The companies in this are ETF are Lockheed Martin, General Dynamics, Raytheon, who make those nice little Stinger missiles, and there's a whole lot of aircraft companies, high-tech companies that are specializing in missiles. So that's the reason that I'm looking at this particular ETF, sort of opportunistically.
John,